Welcome to the Depth Dive. We take stacks of research, articles, financials, expert takes, and boil it all down to what you really need to know.
That's the goal. Get you informed fast.
Today, we're digging into Archer Aviation, ticker ACHR. And this was interesting. It's a company of real contrasts. You've got reasons to be bullish, but also, frankly, reasons for serious caution.
Yeah, and a key takeaway right up front. Our analysis suggests its current share price. It already seems to bake in quite a bit of future success.
Exactly. So our mission today is to give you that shortcut to understanding Archer. They're a pioneer in urban air mobility, or UAM.
Right, and this isn't just about one stock. It's about getting your head around a whole new industry.
Yeah.
I mean, this could genuinely reshape how we travel in cities.
Absolutely. The sources we've used cover the whole spectrum: Archer's business model, their financial health, what the market thinks, and that really complex regulatory maze they're navigating.
So if you want to quickly get up to speed on the future of transport, maybe even cutting-edge tech, this is for you. You'll walk away with a solid handle on Archer and what they're trying to pull off.
Okay. And before we jump in, just a quick reminder, if you find this useful, please do like and subscribe to the Stock Analytics AI YouTube channel.
Yep, helps us a lot. And remember, members paying €4.99 a month get priority deep dives. We're actually covering all the S&P 500 stocks over the next few months, and members get first dibs.
Or if you just want a one-off deep dive on a company you're watching, drop us a super thanks. We do take requests.
Okay, let's get started.
All right. To really understand Archer, we have to start at the beginning. Chapter 1, business analysis. Charting the urban skies. And the big question here, I mean, it's a multi-billion-dollar question, is can Archer, even with all this capital and these powerful partnerships, actually navigate the turbulence, the tech challenges, the regulation?
In this brand new UAM market,
Yeah.
Can they really redefine city travel?
Exactly. Their success, or, even their failure, could set the direction from this whole industry for years, maybe a generation.
It's a big stage. So Archer Aviation Inc., that's NYSE, ACHR, they're based in San Jose, California. Aerospace company, focused entirely on electric vertical takeoff and landing aircraft, eVTOLs.
Right.
And this analysis is current as of July 11th, 2025. Fundamentally, you need to understand they are a pre-revenue development stage company.
Meaning no sales yet, just building and planning?
Precisely. Their core focus right now, design, development, manufacturing, and the big one, getting FAA certification for their eVTOL aircraft.
Okay, but I remember reading it's not just about building the planes. They have this dual stream strategy.
That's right, yeah. They're playing it smart, trying to de-risk things a bit.
Mm-hmm.
The first stream is called Archer Direct.
Archer Direct.
That's where they sell their midnight aircraft directly to other companies. Think airlines, private transport operators, maybe even defense clients.
Okay, so that brings in cash up front.
Yeah.
And someone else handles the operations side.
Exactly. It generates revenue earlier and shifts that capital-intensive job of running the network onto their partners.
Makes sense. And the second stream.
That's Archer UAM. This is their more ambitious play, a direct-to-consumer, vertically integrated air taxi service.
So they'd own and operate their own fleets in cities. Wow.
Yeah, big move. Gives them total control over the customer experience, potentially higher recurring margins down the line. But like you say, it's a huge undertaking.
Feels like more risk, not less.
It's a calculated risk. The idea is the direct sales help fund the UAM networks. And running the UAM networks gives them invaluable real-world data to make the aircraft better and safer. It's supposed to be a virtuous cycle.
Okay, I see the logic. And are they making any money now?
Some, yeah. Interim income from milestone payments tied to partnerships, government contracts. They've actually reported an order book around $6 billion. United Airlines is a big part of that.
$6 billion in orders even before they fly commercially. Impressive. And the aircraft itself, the Midnight, what's special about it?
Midnight is really the centerpiece. It's designed specifically for commercial viability. Piloted, 4 passengers, built for that urban air mobility mission.
And the tech?
It uses their proprietary propulsion system, 12 propellers, distributed electric. 6 of them tilt for vertical lift and forward flight, and 6 are stationary, just for vertical lift.
12 props. Why so many?
Redundancy, safety. If one motor fails, you have plenty of others. That's absolutely critical for flying over cities and gaining public trust.
And noise. That's always the helicopter problem in cities.
Huge factor. Midnight is designed to be nearly 100 times quieter than a conventional helicopter. That's key for urban acceptance.
Okay, what about performance? Range, speed?
It's designed for those short hops. Think 20 to 50-mile routes, turning a 60-90-minute car commute into maybe 10-20 minutes. Max range is about 100 miles, speeds up to 150 miles per hour.
And charging. They need to keep these things flying.
Optimized for quick turnarounds, about a 10-minute charge between flights. That's crucial for maximizing how much each aircraft is used, the asset utilization.
And they didn't start with Midnight, did they? Wasn't there a smaller one first?
Right, the Maker demonstrator. They deliberately pivoted to the larger 6,500-pound Midnight because they needed better unit economics to build a viable business case.
Got it. So where do they stand in the market? Went public via SPAC in 21?
Yeah, September 2021, they're definitely positioned as a leading contender in the U.S. eVTOL market, headquartered in San Jose. And crucially, they're building a high-volume production facility down in Covington, Georgia.
Production, that's key. Who are they working with on that?
Stellantis, the big automotive group. They're leveraging Stellantis' expertise in mass production. The facility could potentially build up to 650 aircraft a year. Initial production is slated for the first half of 2025.
650 a year, that's serious scale. And financially, you mentioned capital raises.
They're in a very strong position, actually. Raised $850 million just in June 2025. That brought their total liquidity to around $2 billion.
$2 billion?
Yeah. Management claims it's the strongest balance sheet in the sector. Gives them a runway for several years to get through this valley of death, the period before commercial revenue starts flowing.
Okay. Their value proposition is unlock the skies. So safe, sustainable, quiet, competitive transport. Saving time.
Dramatically saving time. And the environmental angle is big, too.
Yeah.
Zero operational emissions. They position themselves as a climate tech innovator. Might even get carbon credit revenue eventually.
All right, let's zoom out now. Chapter 2, industry dynamics, the urban air race. What's the big picture for this whole UAM market?
The forecasts are, well, pretty staggering. Some see the market hitting over $23 billion by 2030. Compound annual growth rates projected in the 35%, even over 40% range through 2030 or 2032.
Wow. What's driving that kind of growth?
It's pretty clear. Urban congestion is just getting worse. There's huge demand for greener, quieter transport options and the potential to expand beyond just city centers to regional routes. Plus, tech trends like AI, big data, IoT are all feeding into it.
But it's not just Archer, right? It feels like a crowded space.
Oh, very crowded. You've got other pure-play eVTOL companies, Joby Aviation, Vertical Aerospace, EHang over in China, Lilium in Germany.
And the big aerospace guys are involved too.
Yep. Boeing has Whisk Aero, Hyundai's got a division. Even Stellantis, besides partnering with Archer, is exploring things. The Archer versus Joby rivalry is particularly intense. They get compared constantly, volatility, who owns the stock, media buzz.
Right. I see the comparison here from July 11th. Archer at $10.51, Joby at $12.04. But Archer has a strong buy consensus, Joby a moderate buy.
And Archer's average price target is higher too, $13.13 versus $10 for Joby, Archer's key partners. United, Stellantis, Palantir, Anduril, Joby's, Delta, Toyota, Uber.
Both targeting certification late 2025.
That's the timeline they're both aiming for, yeah.
Yeah.
A key difference, though, is cash. After that recent raise, Archer's got about $2 billion in liquidity. Joby's closer to $1 billion.
Okay. Now, the elephant in the room, regulations. The FAA, this powered lift category, seems critical.
Absolutely critical. Probably the single biggest hurdle. The FAA has its Innovate 28 plan aiming for commercial UAM operations by 2028.
And Archer needs specific certifications.
3 key ones. Part 135, that's for being an air carrier operator. Part 141 for pilot training. They actually have both of those already.
They do. That's significant.
It is. But the big one, the hardest one, is the FAA type certification. That certifies the design of the aircraft itself is safe. That's what they're hoping for by late 2025.
Late 2025. Still a ways off. Any positive signs on the regulatory front?
One positive development is this 5-country alliance, U.S., U.K., Canada, Australia, New Zealand, I believe, working to harmonize global certification standards. That could make international expansion much smoother down the road.
So, given all these hurdles, tech, competition, regulation, are there strong barriers to entry? Is there a moat?
Oh, definitely. The barriers are formidable. First, just the sheer amount of capital needed, over $1 billion minimum, just to be a serious player.
$1 billion.
Okay. Second, the technological complexity is immense. Composites, batteries, thermal management, keeping it quiet. It's incredibly hard engineering.
Third,
the FAA regulatory gauntlet itself, it takes years. Companies like Archer that started early have a significant head start. It's a multi-year process.
and finally,
Infrastructure, building out the network of vertiports, the landing and takeoff pads, that's another massive cost and logistical challenge.
Okay, so high barriers. What about Archer's specific competitive advantages? What makes them stand out?
Well, their brand is getting strong, boosted by those big partnerships, United, Stellantis, that gives them legitimacy. And being the official air taxi for the LA28 Olympics, that's huge global marketing, a real confidence signal.
LA28, yeah, that's a big deal. What about cost advantages? Economies of scale?
The Stellantis partnership is key there. Leveraging their automotive mass production know-how should help make Midnight production more cost-efficient.
Right, the car manufacturing experience.
Exactly. And designing Midnight for those quick 20, 50-mile trips in that 10-minute charge, that maximizes asset utilization, which directly lowers the operating cost per flight.
You mentioned vertiports earlier. Any network effects? A vertiport as a service moat?
Yeah, that's part of their strategy. They're partnering with companies like JetX and Atlantic Aviation. These are established players in private aviation terminals, FBOs, and heliports.
So they retrofit existing sites instead of building new ones?
Primarily, yes. It's faster and much less capital intensive. The idea is the more vertiports they have access to, the more useful the service becomes, attracting more passengers, which justifies adding more routes and vertiports. It's a classic network effect, creating a moat over time.
Makes sense. Any other unique assets or capabilities setting them apart?
I'd point to their vertically integrated model. They're not just making planes. They plan to operate their own UAM service. That gives them full control, end-to-end.
Control the whole experience.
And capture more value. Also, their proactive work with the FAA, designing Midnight alongside the FAA, as they put it, should streamline certification. And don't forget the defense angle. Partnering with Anduril Industries opens up government contracts. That's non-cyclical revenue, potentially subsidizing their commercial R&D.
So summing it up, it's like an outsourced expertise model.
In a way, yeah. Stellantis for manufacturing, United for demand and operations insights, JetX Atlantic for infrastructure. It lets Archer focus on their core job, designing and certifying the aircraft.
Yeah.
Systematically de-risking pieces of the puzzle.
Okay, interesting strategy. Let's shift gears. Chapter 3, management evaluation. The pilots in the cockpit. Leadership is critical here. What's the take on Archer's team?
Seems like a strong mix. You've got Adam Goldstein, the founder and CEO. He's a serial entrepreneur, had a successful exit before Archer with a company called Vettery.
Right. His co-founder left, though.
Yeah. Brett Adcock departed back in 2022, but Goldstein seems firmly in charge. And the wider team has deep aerospace and tech chops. Tom Muniz, the CTO, came from Wisk Aero, a competitor. Dr. Jeff Bauer, chief engineer, was at Airbus. Mark Maisler is the CFO.
Any standout hires that signal something important?
Absolutely. Billy Nolan, their chief regulatory affairs officer.
Nolan wasn't...
Former acting administrator of the FAA.
Wow. Having the former head of the FAA on your team, that seems like a massive advantage navigating those regulations.
It's huge. You could call it a masterstroke. Gives them unparalleled insight into the process, how regulators think. Helps them anticipate issues.
Does that raise any eyebrows, though, having such a high-profile former regulator? Even if it's all above board?
Well, it certainly provides incredible insight and credibility. You know, the perception is generally positive signals. They're serious and knowledgeable. Any concerns about, say, undue influence are usually handled by strict ethics rules, and the fact that the whole regulatory process is pretty public.
Okay. But management hasn't had a totally smooth ride. There were legal challenges. The Wisk Aero lawsuit.
Right. That was a trade secrets lawsuit. It was settled.
Yeah.
There was also a securities class action lawsuit, spurred by a short seller report.
How did that play out?
Archer fought it, and significantly, the plaintiff voluntarily dismissed the case. That was a big win for Archer, basically repudiating the short seller's claims and removing a major legal cloud.
Good for them. How is their communication? Transparency, ethics?
Seems pretty robust.
Yeah.
They do regular earnings calls, investor presentations. They have clear governance policies, code of conduct, insider trading policy, whistleblower policy, all publicly available.
And the board.
Includes independent directors for oversight. Plus, they actually got certified as a great place to work. Employee satisfaction was reported way above average. Suggests a motivated team, which is crucial.
All right, let's talk money. Capital allocation, where's all that investment going?
Pretty much 100% back into the business. Core growth, R&D, which was huge, over $350 million in FY 2024, scaling up manufacturing in Georgia. General admin costs, it's all organic growth right now. No major acquisitions.
And shareholder returns? Dividends? buybacks.
None. They don't pay a dividend, no plans to. No history of share buybacks either. In fact, it's the opposite.
They've been issuing shares? Dilution.
Significantly. About 86% dilution in the past year.
Yeah.
But look, that's the trade-off for a pre-revenue company in this phase. They need that capital to fund everything until the revenue starts. Issuing equity is how they do it.
So return on invested capital, ROIC, must be, well, pretty bad right now.
Oh, yeah, deeply negative, like negative 42.55%. But again, that's completely expected. It's unavoidable when you're investing everything up front. The whole investment case rests on the potential for high ROIC later, once they're flying commercially and scaling up.
Right, it's all about the future payoff. Okay, let's move to Chapter 4, Financial Analysis, Fueling the Future. Give us the snapshot of Archer's financials.
Okay, as of mid-July 2025, their market cap is sitting around $6.66 billion.
$6.6 billion for a pre-revenue company. That really underscores the market's expectations, doesn't it?
Absolutely. Revenue in FY 2023 was zero. First meaningful revenue isn't expected until FY 2025, maybe around $11 million, likely from those milestone payments we talked about.
So profits, margins.
All zero or negative right now. They're operating at a significant loss. Net loss for the 12 months ending March 31st, 2025 was about $514 million.
$500 million loss in a year. And free cash flow.
Consistently substantially negative. The annual cash burn rate is estimated around $450 million. Just for context, they burned through about $236 million in operating activities alone in FY 2023.
Okay, big losses, burning cash fast. But you said earlier their financial stability is strong. How does that work?
It's counterintuitive, but yes. While the losses are expected for this stage, they've consistently beaten analyst estimates on earnings per share, suggesting they're managing costs perhaps better than expected. And crucially, look at their balance sheet. Debt-to-equity ratio is incredibly low, like 0.08 or 6.3%. They have way more cash than debt. Minimal leverage risk.
And the current ratio, liquidity.
Extremely strong. Current ratio is 15.8. A typical healthy range might be 1.5 to 3. So 15.8 means they have an overwhelming ability to cover their short-term obligations.
So it's that barbell strategy you mentioned.
Exactly. High risk on the income statement, zero revenue, huge cash burn. Balanced by extreme safety on the balance sheet, funded by equity, holding $2 billion in cash, minimal debt. They're trading that shareholder dilution to guarantee survival through this critical development phase.
Okay, the billion-dollar question, or maybe the $6.66 billion question, valuation. How do you even value a company like this?
It's really, really tough. Standard metrics like PE or price to sales, meaningless right now.
Price to book.
It's high, around 5.7 to 7.1. That tells you the market isn't valuing their physical assets much. It's valuing the intangibles, the tech, the partnerships, the progress with the FAA, and especially that huge future growth potential.
So you have to look at intrinsic value, discounted cash flow, DCF.
That's the main tool, yes. Trying to estimate all their future free cash flows and discount them back to today's value. But for Archer, a BCF is extremely sensitive to your assumptions.
What are the key assumptions you have to make?
You need multi-stage cash flow projections. First, negative cash flows for a few years. Then, hopefully, a period of hypergrowth as they scale up, then eventually stable growth.
And the discount rate, that seems critical.
Absolutely crucial. Because the risks are so high, technological risk, regulatory risk, market adoption risk, you need to use a very high discount rate, or WACC. We're talking maybe 20% to 30%.
Much higher than a typical established aerospace company.
Way higher. The WACC might be more like 7% to 11%. Archer's stock beta, a measure of volatility, is over 3.0. which supports using a much higher discount rate reflecting that risk.
So if you run an educational DCF model, what does it suggest about the current price?
Well, running a sensitivity analysis, varying the discount rate and the long-term terminal growth rate shows something interesting. The current share price, around $10.51, is actually consistent with using a high discount rate, say 20%, and a moderate terminal growth rate, maybe 2.5%. Meaning the market is already pricing in a significant amount of future success and effectively acknowledging the high risks through that high discount rate.
So for the stock to have significant upside from here,
you need to believe either the risks are actually lower than that 20% discount rate implies, or that their future growth and profitability will be even better than what's currently baked in. The range of potential values in the model is wide, underscoring just how much depends on future execution.
Okay, that puts the valuation challenge in perspective. Let's switch to Chapter 5, Market Sentiment. How does Wall Street see Archer?
The analyst community. Overwhelmingly positive. The consensus rating is a strong buy. You typically see 7 or 8 analysts with buy or strong buy ratings, maybe 1 or 2 at hold.
And price targets?
The average 12-month target is around $13.13. That implies about 25% upside from the current $10.51. But there's a very wide range around that average, from as low as $4.50 to as high as $18. Shows a divergence of opinions even among the bulls.
What about the general media narrative? Recent news.
Mostly positive, mostly forward-looking. Lots of focus on milestones, that $850 million capital raise, the LA-28 Olympics deal, progress on launching in the UAE, the partnership with Palantir for AI.
So the story is generally one of a well-funded leader hitting its marks.
That's the dominant narrative, yeah. But you do see cautious commentary, too. People point out the obvious. Still, pre-revenue, burning cash, valuation looks stretched based on current reality.
Which brings us to short interest. This seems like a major contradiction. High analyst ratings, but lots of people betting against it.
It's definitely a battleground stock.
Right.
Short interest is significant, reported anywhere from 12.6% up to a really high 21.4% of the float. That's around 95 million shares short.
Why the disconnect? Analysts bullish, shorters bearish.
It highlights the different time horizons and focuses. Analysts are looking years ahead at the potential market dominance. Short sellers are focused on the now. Zero revenue, $450 million annual cash burn, nearly $7 billion market cap. They're betting the execution risks are too high or the timeline too long.
So it's a binary bet, really.
Pretty much. If Archer keeps executing, hitting milestones, getting certified, you could see a major short squeeze as shorters are forced to cover. But any significant setback, a delay, a safety issue, could validate the short thesis and send the stock down hard.
And technically, moving averages.
From a technical perspective, it looks bullish right now. The stock at $10.51 is trading above both its 50-day and 200-day moving averages.
Okay, let's look at who actually owns the stock. Chapter 6, ownership structure. This often tells the story. What about institutions?
Institutional ownership is quite high, somewhere between 32.5% and nearly 60% of the company. You've got the big index players like BlackRock, State Street, Vanguard.
So it's in major indexes.
Yes. But also, significantly, ARK Investment Management Cathie Wood's firm is a major holder. That signals strong conviction from a prominent growth and innovation-focused investor. And the trend is positive. More institutions have been increasing their stakes than decreasing them lately.
What about insiders? Management.
They have significant skin in the game. Insider ownership is substantial. Estimates range from 8.3% up to 27%. CEO Adam Goldstein alone owns about 5.74%, worth over $380 million.
Have there been insider sales?
Yes, there have been sales, included by Goldstein, but these are often done through prearranged Rule 10b5-1 trading plans.
Ah, the scheduled plans for diversification or personal finance.
Exactly. It's standard practice, helps avoid any appearance of trading on non-public info. Plus, they continually receive restricted stock units, RSUs, as part of their compensation, so their equity exposure gets replenished. Incentives seem aligned.
Is ownership concentrated? And are there strategic owners?
It's reasonably concentrated. The top 25 shareholders control about 43%. And yes, crucially, there's strategic corporate ownership. Stellantis, their manufacturing partner, is a major equity investor. United Airlines, their key launch partner, is also an investor.
So you have the manufacturers and the customers invested.
Right. It creates this powerful validation, what we call the smart money trifecta. You've got strategic validation from corporate partners who've done deep due diligence. You've got growth investor validation from firms like ARK, and broad market validation from being in the indexes. That's a strong signal of confidence.
Okay, very insightful. But no investment is risk-free. Let's tackle Chapter 7, risk assessment. Maybe start with a quick SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sure. Strengths. Definitely their technology and innovation, that strong balance sheet with $2 billion in cash, the strategic partnerships we just discussed, and experienced management, including Billy Nolan.
Weaknesses?
Obvious ones. Still pre-revenue, the high cash burn rate, huge dependence on flawless execution, and the past and potential future shareholder dilution.
Opportunities.
Massive market potential, that huge total addressable market, or TAM, expanding into the defense sector, global expansion beyond the U.S., maybe even the carbon credit market down the line.
And the big one, threats.
Number one is probably regulatory risk specifically. Delays or failure in getting that final FAA-type certification. Intense competition from Joby and others. Potential technological or safety setbacks.
Yeah.
And hurdles around public acceptance and building out that vertiport infrastructure.
Let's dive deeper into a few key threats. Macroeconomic factors. How do things like interest rates and inflation hit a company like Archer?
Hard. Higher interest rates directly increase the discount rate, that WACC we talked about. That lowers the present value of all those future hoped-for cash flows, putting downward pressure on the valuation today.
And inflation.
Increases their costs, materials, labor.
Mm.
That worsens the cash burn and potentially shortens that crucial capital runway they have. Makes survival harder if commercialization takes longer than expected.
What about geopolitics, say tariffs, like the U.S. ones in 2025?
Yeah, good example. Archer relies on a global supply chain for components. If tariffs get slapped on parts coming from key countries, that directly increases their cost of building the aircraft. That either squeezes their future profit margins or forces them to raise prices, which could hurt demand. It highlights supply chain vulnerability.
Then there's this idea of unmodeled contagion risk. Sounds ominous.
It is, in a way. It's the risk of a single major safety incident, whether it's an Archer aircraft or even a competitor's.
So an accident anywhere in the sector could hurt everyone.
Exactly. In a brand new industry like UAM, a high-profile crash, maybe due to battery fire, a software glitch, even pilot disorientation in these new machines, it could be devastating.
What could happen?
FAA could ground the entire fleet category, trigger sweeping, costly new regulations, and ignite huge public backlash. Not in my backyard, or NIMBYism against vertiports. It could set the whole industry back years. Archer's fate is partly tied to the safety record of its rivals, which is a scary, unquantifiable risk.
Definitely a sobering thought. Okay, let's bring it all together. Chapter 8. Conclusion. Synthesize these findings. Archer is this company of contrasts. What's the bull case distilled?
The bull case is compelling. Archer looks like a well-capitalized, strategically smart leader in what could be a truly transformative market. They have top-tier liquidity, deep partnerships linked with equity, Stellantis, United, JetX, proven management with that ex-FAA head, a clear certification path, a manufacturing plan, a major launch customer locked in, and strong backing from smart money. If they execute, they're incredibly well-positioned to win in the U.S. UAM market and then go global.
But there's a significant bear case, too. What are the core arguments against Archer?
The bear case is stark. It remains highly speculative, pre-revenue. That nearly $7 billion valuation is built purely on future promises, not present performance. The $450 million annual cash burn is fundamentally unsustainable without achieving commercial success relatively soon. And the path forward is littered with massive execution risks. Nailing that final FAA certification, scaling up manufacturing of a novel aircraft design, avoiding any major tech or safety failures, the high short interest reflects this deep market skepticism about overcoming these hurdles.
And summarizing the valuation picture.
Intrinsic value is really hard to pin down, incredibly sensitive to those long-term assumptions about risk and growth. Our DCF modeling suggests the current $10.51 price already implies a high degree of success is expected, consistent with a high discount rate around 20% and moderate long-term growth.
So significant success is already priced in.
Pretty much. For the stock to offer compelling upside from here, you really need to believe either the risks are lower than the market thinks, or that Archer's future growth and profitability will be even more spectacular than what's already reflected in that $10.51 price.
So the final outlook on Archer Aviation.
It's the quintessential high-risk, high-reward investment, a bet on disruptive innovation. The investment case hinges entirely, 100%, on management's ability to execute an incredibly complex, capital-intensive plan in a completely unproven industry.
They seem to have the pieces: capital, partners, expertise.
They've assembled an impressive set of resources, arguably the best in the sector. They've ticked a lot of boxes. But the ultimate question mark hangs over execution. Can they actually deliver?
All right, let's leave our listeners with a final thought to chew on. Building on what we've discussed, what might the world actually look like if Archer or one of its competitors really succeeds? If urban air mobility becomes a daily reality?
Yeah, how would that fundamentally change our cities, our commutes, even how we think about personal space and distance? It's a profound shift to contemplate.
Indeed. Well, if this deep dive got you thinking, please remember to like and subscribe to Stock Analytics AI for more analyses like this.
And remember, members get priority on deep dives, including our upcoming coverage of the entire S&P 500. Or drop a super thanks if you have a specific ticker request.
And finally, the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice. Always do your own research or talk to a qualified financial advisor before making any investment decisions.
Thanks for tuning in to the Deep Dive.